Hi, Deborah. Hi, Michael. It's really great to see you. How are you getting on?
Hi, Rebecca. How are you today?
I'm good. I'm good. What's it like over there? So, what you're in New York, aren't you?
No, I'm actually in Dallas, Texas,
Oh, I
and
forgot. Yeah, it's Kevin. It's Kevin who I know your colleague is in New York, isn't
in
it?
New York, New
So,
Jersey.
yeah, I forgot you're over there. Yeah. What
But
about
we
Hey,
you?
Rebecca. Mm.
Yeah, what
Hi.
about you? Where are you?
I'm generally in New York, but today I'm actually in very warm South Florida today. So,
Oh,
um,
I'm not
little...
jealous at all. Sitting in cold Northampton, yeah, the UK. Oh, lovely. Well, we're here to talk about real estate, aren't we? TRI and real estate. So tell me what's happening in the commercial real estate sector in the US. What's the landscape looking like? Do you want to kick off, Deborah?
sure, sure. So our market is what, 5.6 trillion or so, and our overall default rate probably is still under 5%. We are seeing, a lot of challenges in our office market, and we're seeing a real flight to quality. So, a Class A building is great, but anything less than that is challenged. And our credit markets are pretty much frozen up at this point.
Hey, sounds great. So how,
Great
how
environment for
yeah.
us professionals.
Yeah, awesome. So how are property valuations holding? What that's the question everyone always wants to know, isn't it?
Yeah. So
Yeah.
I think before oh, sorry, Deborah, I don't know if you wanted to address that
No,
or
go
yeah.
ahead, jump in there.
I just think when we talk about commercial real estate, I think it's also important to understand there are different categories. I think Deborah, you started to hit on this. So there's office, right, which is one big category, which I think we'll be spending most of our time on. But when people talk about commercial real estate, they also lump in multifamily, retail. And so I think when we look at that category, depending on which asset class you're looking at and which location, the answer is a little bit different. So I think office, I would say across the board, not very good. We're definitely seeing a nationwide distress on office class. In multifamily, I think you're starting to see differentiation based on location. So the Southeast, I think, is starting to see rent growth slow or stop, and that's having an impact on values and transactions. Northeast seems to still be going strong. Unclear, when interest rates and all the other things we'll be talking about today are going to start to catch up. So you're seeing a little bit less, in terms of downward pressure on the multifamily. I think that's holding up well. And retail, surprisingly, is starting to perhaps, I don't know, bounce back, but certainly stop the precipitous fall it's been on and start to stabilize or even grow. The vacancy rates are starting to decrease on the retail side. It's still not wonderful, but it is better than it was, several years back when it was all doom and gloom.
Yeah, it doesn't sound too cheery. So, I mean, you've gone through quite a few different areas there, but what are the key things that are driving these downward valuations? What's behind
So yeah, so it's really a multi-factor, multiple factors. First of all, I think we unfortunately know that a lot of these projects were either built or acquired in a 0% interest rate environment. And so as those loans are going mature, which I think this year is forecasted to be a little less than $1 trillion, about $920 billion roughly of commercial mortgages that are going to become due. Then at the current interest rates, whatever their assumptions were going into these projects are no longer the case given where interest rates are. So that's a challenge. In addition, I think that you have increase in costs, operating costs for office buildings. And of course, then you have the pandemic and the flight out of buildings by a lot of companies, which increased vacancies to record levels. And so you have the combination of those factors are not very good, obviously, and create a lot of issues. And then on top of all that, you have very few transactions because sellers are not willing to sell, banks are not willing to recognize those losses, and the few transactions that are out there are so distressed and cause even a lower comp point because those prices are so low. So you take that volatile combination and it's not a good impact on pricing.
No, I can see that. So, Deborah, I mean, do you think this is as bad as the global financial crisis back in 2008 to 2010?
I don't think we're yet there. So I think that we are at the beginning of our crisis. I don't feel like we are in the middle or even at the end, because as Michael alluded, we have not seen a lot of transactions, which means we have not had a lot of resets in values and exposure. And to go back to your earlier question, the higher interest rates result in everyone wanting a greater yield than they were willing to take, 5 or 3 years ago. So because they want more yield, more return on their money, they are pricing in that return, which is resulting in a lower value on the real estate. So where an office building may have sold for a 6% cap rate a couple of years ago, today that cap rate is going to be 8 or 9. And that's if it can get, financing and the equity around it needed to close. Before, we saw equity markets willing to participate at a 20% level because the major loss and the major amount of capital would come from the financing. So financing would cover 75, 80% of the capital stack needed to buy an asset. And then you would backfill the rest with equity or mezz or preferred equity, things like that. The 75% loan to value financing is now down to 55 or 60%. And so you don't see a lot of investors interested in taking that other 40%. No one's really interested in taking that other 40%. The other thing that we've seen is, the capital markets, as I mentioned, have locked up basically. It's not a complete lock, but it's a very selective lock. They are very selective with their money and where they put it. And they're also very selective about their financing terms. And without financing, real estate pretty much doesn't work. Owning real estate without leverage rarely gives an investor the yield that they're looking for in an asset.
Yeah, no, I mean, that's a big issue, isn't it? Financing is probably your most important thing behind these deals. So what are the banks actually doing? How are they responding, and how are they handling things?
Yeah, the banks are taking a very hard approach to real estate. So they don't want to extend. They are quietly moving assets, loans off of their books. And whether they do it through just a private transaction, or they go out into the market and use a firm to market their portfolio, they are gradually moving assets, loans off their books. And they are doing it, at quarter end, a quarter at a time, basically, to mitigate their exposure to commercial real estate. There's a directive, whether it's published or unpublished. The message is reduce your exposure to commercial real estate. So they're also not lending, right? So they're not making new loans except for like construction loans or things along, a construction loan for a brand new build, which will, with your pro forma, and once it's finished and a CO, you'll be taken out, or else they'll move it to a permanent loan in, a brand new asset, which if you have a Class A, top of the line, brand new asset, you have financing options. But if you don't, there are no financing options almost.
Yeah, I can see that. So Michael, who is filling the gap for this finance? If they can't get the finance, you can't do anything. So who's filling that gap at the moment?
Well, I think as Deborah said, remember there are two sides of this coin, and one is the banks, and on that there is a private credit market, a pretty robust credit market that's willing to step in at the right values, and I think are willing to go beyond or deeper than a traditional bank will be to fill in some of that gap. But as Deborah mentioned, that only solves half of the problem. The other problem is the equity, and that is a very difficult one, and is not solved by the private credit market. And so what we're seeing is the sponsors looking at much more complex structures, bringing in mezz loans, junior secured, preferred equity, trying as much as they can to fill in that, the gap between what used to be, 25% and now 40-45%. And that's building in, more complex structures, more difficult to negotiate. And it's just making deals much more difficult. I think the one thing that's important to mention here is, people compare this to 2008 and say, well, haven't we been through this before? And I think, Deborah, you alluded to this earlier. It's really not the same at all. 2008 was a very sharp decline and a very steep and decline, but then a very quick uptick. So you didn't have a prolonged time frame of distressed real estate going through out-of-court restructurings or bankruptcy restructurings or so on. So people that just, if you had to sell at that time, obviously you had catastrophic losses. But if you were able to hold it together, you could, you made it through and you made it to the other side, and you were still in a 0% interest environment and you were able to hang on. Today, it's not just that there was a dislocation in the debt market or the equity market. You have a dislocation in the world, and work has changed. Office buildings have changed. Cities have changed. Interest rates have changed. Costs have changed, and that's going to be a prolonged process. It's not going to be over in a few months, and so it's going to require a whole new toolkit to really to get to the resolutions of these issues.
So,
Yeah,
sorry, Debra, carry on.
Oh, to Michael's point, that's why I say we're closer to the beginning. I don't feel like we're at a half, and I don't feel like we're on the back end of this, because we are still navigating work from home globally, right? We have all enjoyed and embraced that. We've realized what technology has done for us and how it allows us to work. And we need to find generally accepted work from home flex scheduling that makes it worthwhile to have your real estate presence, yet also have a good peace of mind with your employees, because our employees want more from us today, and they want more from their job, right? And so finding that balance is really important, and it's not always everyone in the office all the time. And the other thing around that is also to Michael's point about filling the gap. We have mortgage REITs right now. They are, they're busy. They've categorized their loans, and they're either going to get rid of their troubled loans or they're going to address them. So they're kind of holding still on originations. And the same with the CLO market. It's kind of holding still on it. It's dealing with its troubles. But what we will see are those market capital providers will come back. We've seen a lot of in the secondary market. The other thing is the secondary transactions, right? So lots of firms have raised a significant amount of capital to come in and recap those deals, either through a GP recap or a sell recap. And that's where we will see this market starting to turn, is when that money starts to get deployed in big chunks. And Michael, you've probably worked on transactions like that, or kicking them on right now.
Yes. Yeah, no, and I think I saw a Deloitte report that there's $2 trillion of private equity money sitting on the sidelines waiting to be deployed. So, I think if you look ahead, in a way, I think there will be more transactions. It's not going to be at prices that are going to make the equity sponsors very happy or the banks very happy. But at some point, right, there is going to be the log jam is going to have to break. And when that happens, I don't know. I don't have a crystal ball, but at some point, the banks are going to have to realize, to recognize what's on their portfolio, and lenders are going to have to deal with it, and equity sponsors are going to have to deal with a new reality. And I think if you have a long-term view of real estate, there probably are going to be a lot of opportunities coming in the next, coming months or years.
So how does this all knock on into the TRI area, turnaround, restructuring, insolvency? So Debra, what do you think?
Oh my goodness. So I would just tell you, we are getting, 2 or 3 calls a week for help with restructuring. So we're looking to be collaborative and creative, find new capital, find new structuring ideas. We're just like, what would work? What if we did this? What if we did this? And our existing investors, so far, our clients that have existing capital, they're really just looking to save their position. They're not trying to pursue yield or, look at, above market returns. Our lenders and mortgage holders that we're dealing with, because some are lenders and some are just mortgage holders, are really, they just want to be paid off and they want to be out of this environment. They want to de-risk, right? And then the new money that is coming in that we're seeing is looking for, high double-digit yields. They want, something closer to a 20, which we've seen that before too. During the GFC, we saw people looking for 20s on their new money or high teens on their new money. And so that is back. I see that. But I also see that they're not interested in taking a risk on, your average asset in your average market. They want, to buy, top 10 MSA office at, below replacement cost. And that is happening in some, it happened in the West Coast, in our West Coast in San Francisco, right? We've seen that happen. I think also though, and Michael, you probably see this, we still see a lot of the international markets looking to the US to deploy capital. So whatever we're feeling here, internationally, we still look good as an investment opportunity for real estate. Right, Michael?
No, that's absolutely true. And I think we've seen, I've been, representing quite a few international investors that either in the debt market or equity, private loans, looking at the US market and especially in and around the New York area, I would say right now, although that is starting to get priced a little bit, so they're looking outside of that. But we are definitely seeing that. I think one of the other things is you have a lot of European and international money that's invested in these projects, usually because of tax reasons, either in a minority position or in a loan position. And they have, on top of all the issues we're discussing, right, they have tax issues that prevent them from taking over a project or moving forward. And so there are a lot of other hurdles that we haven't even touched on that those international investors are going to have to deal with in terms of projects that they're involved in that may be distressed. They can't just simply say, okay, we're kicking out the GP and taking over the project. That creates huge tax issues for them. So they have to find a new partner to come in and take that position, which makes it even more difficult. So I do see some of that.
Do you ever use bankruptcy as a tool to sort of help move things forward within real estate?
So, I have spent, 20 plus years on the lender side, being the lender that's collecting. And, especially after the GFC, lenders would write into their documents and always have pretty much, if you file bankruptcy, then the loan becomes 100% recourse to the borrower and to a guarantor. And the guarantor is usually a warm body. So while you want to have that bankruptcy as a protection to pay all your debts and move forward, you can't use it because it turns your loan into full recourse. But instead, really, it's a tool that you can use to your advantage, especially in state-specific restructures and reorganizations like Michael's doing in New York.
Yeah, so I have had a couple of transactions where collaboratively between the lender and the borrower, the borrower filed for bankruptcy in order to effect a transaction through a bankruptcy proceeding, and that proceeding allows you to do a couple of things. One, it can solve mechanic lien issues if you have them, whether they're disputed or not, or it's a forum for solving those issues. Also, if there are competing claims that need to be dealt with that would hinder a sale process outside of bankruptcy, it can be dealt with more efficiently within the bankruptcy. And also importantly, if you do the sale through a bankruptcy plan, you can save on real estate transfer taxes, which in New York I think are close to 3%. So in New York City, so on larger projects, that's a pretty significant savings that can be accomplished through a bankruptcy. So I think going back to some of the things we said earlier, that this is different in 2008 because this is going to be a more prolonged process, and I think that because there is a more prolonged downturn and these issues are not going to be solved on a macro level, I think more and more you're going to find borrowers and lenders turning to the bankruptcy process to help solve some of these problems. And I think one of the things we're going to see is more bankruptcies and less, as opposed to all of these things being done outside in and out of court restructurings.
Yeah, and you have this, you have the same, if not better, protections in bankruptcy court because you're held to a budget, you're held to reporting. Those things have to happen, and it's very structured. You get to negotiate that up front, and you know where you're going, and there are specific deadlines and timeframes. And yes, you will get grace, often you will get grace from the court of, okay, 30 more days or 60 more days. There are floodgates or gates in place that prevent this from going on years, usually, right? You have to start paying, right? And a single asset structure, you have to start paying or file your plan. There are things out there that protect the lender, even though you're in bankruptcy. And I just think it's a great opportunity to create a restructure and save money if you do it right.
Yeah, and I think the flip side is I think lenders are finding that the state court process of foreclosure for those states that require a judicial foreclosure process like New York, can take 2 years to get resolved. And so I think one of the things that I as representing the lenders, I sometimes push the bankruptcy because that can be done in a matter of months as opposed to several years, if everyone is on the same side. So I think there are a lot of advantages to bankruptcy that lenders will start taking into account, and I think you're going to see more bankruptcies involved in these cases.
So guys, have you got an example of a project that you could perhaps talk through, sort of give us an overview of perhaps a mall development or an office redevelopment? Have you got an example at all?
Of a restructure that we've done?
Yeah.
Yes, I will tell you, I have a Class B office building that, it's got a 60% occupancy. It's been a long-term asset for the owner. They've probably owned it for 20 plus years and had several refinancings and been able to pull out a lot of equity along the way. And now, we're at a point of, do we give it back to the lender or do we put new money in it and get a restructure because the loan matured? And we've been able on that asset to negotiate a restructure, and the sponsor will put some more money in the deal. It'll go toward the real estate. It's very important that if you're going to put new money in a deal, is it going to fees or is it going to real estate? And while fees are really nice, it's really important to put it into the real estate because at the end of the day, that's how you get paid back. So we've got that restructure that we're working on. We've also done some short-term extensions on matured loans to give more time for financing because, usually you're out there in the market about 96, 3 months ahead of time pursuing your refinancing. And we're finding that it's taking longer, more like 6 months, because you'll start with one and then find out something doesn't work and you need another. So to the extent you can deploy to, plan A, plan B, but most of them are, everyone wants an exclusivity if they're trying to place debt for you, especially a significant amount of debt. So we're if we're going to do anything on an extension to allow refinancing, we want 6 months, and we're seeing that we're getting that. The other thing is sometimes we have to give an asset back, and we help negotiate the give back and putting in the receiver and making sure the bills get paid and things like that, because at the end of the day, you're just trying to maintain the asset for the ultimate owner, which might be the lender. So
what about you, Michael?
So I'll give an example of a couple of different things we talked about. We'll start with the bad news first and then hopefully end up with some good news, right? On the bad news front, aside from one where Debra and I are working on, where we're literally pushing the property back and forth across the table to the bank and the bank keeps pushing it back to us. I have another situation where another office building, in the Chicago area, and that's a city that is experiencing very challenging environment for office buildings. And there's another situation where the operating expenses don't cover the revenue doesn't cover the operating expenses, let alone the debt. So it's again a situation where the bank just simply doesn't want, we've offered the lender and the keys, and the lender said no thank you, and so we're going through that. So that's a very an active example of what we're talking about here.
I can help with that. I'm working on another asset in Chicago where we restructured, where the bank took the deal back, but they didn't take the deal back, and they put in a new owner and a board. So let me help you with that.
All right, that sounds good. Then we've had some success in doing a complex international restructuring of international investor corporate level, mezzanine level loans into a structure where, rather than take over the company, we've restructured in the equity, put in new money, and we've extended now for 2 or 3, I think it's 3 years, with a payout plan, and we hope that that's going to stabilize the properties and hopefully get our clients paid back. And then on the good news front, we hope to close a sale of a hotel in Williamsburg, Brooklyn, this summer, where our clients are owed about $180 million, and they, knock wood, assuming it closes in July, will get paid back pretty much par. So, and when we started this process about 2 or 3 years ago, the values that they were expecting were far lower than that. So that's an example of how local and how this market can be at some time, right? Where if you say, how's the hotel market in New York? You can't really answer that question, right? But this is a good property in a good location. It has a good record, and it brought in a good value in a robust sale process. So there are pockets of good news every once in a while, and at least that wanted to at least convey that it's not all doom and gloom. But as Debra, you mentioned this earlier, good properties, Class A properties, good hospitality properties, good multifamily properties will get interest, and because there is money to be deployed. Unfortunately, there are a lot of other things that Debra and I are spending most of our time on. But
yeah, it's really a flight to quality at this point in this market. But after quality gets gobbled up, then equity never or yield never forgets itself, right? So people will start looking for yield, and then they'll move to the Class B and the Class C, and that's what creates a market for us.
No, I completely get that. So, I mean, you guys are utterly immersed in the real estate market, total experts on the whole area. What do you see as the future? What's going to happen next?
well, I think
crystal ball. I always love the crystal
Who's
ball.
got the crystal ball right now, Michael?
okay, shaking it. No, I think I really just expanding on what we talked about earlier. There's a lot of money sitting on the sidelines that is very anxious to be deployed. There are a lot of more. There's approximately $1 billion. $929 billion of mortgages that need to be refinanced or paid. So I think my view is that I don't know when, but at some point there will need to be a breaking of that log jam. It just can't go forever. And unlike the 2008 crisis, I don't think the macro economy is going to save this situation. I think there's just too much that has changed for the long term that just extending helped in 2008, and those that did it ended up, even though they were criticized at the time, it ended up for the most part working because the macro economy came back and everything else remained the same. I don't see, again, I'm not an economist, I don't see interest rates going down to 2% and or mortgage rates going down to 2%. I don't see the pricing, the prices that the increase in prices that we've seen. I don't see those reversing. And even if the hybrid and remote starts to shift a little bit, I don't know if it'll be enough to shift such that the vacancy rates will go back to historical levels. And if that's the case at some point, then we have to do something, right?
Yeah. What about you, Deborah?
Right. So I think, playing off of Michael, I think on the logjam, I think what has to happen, I mean, he's covered all the basics, right? Rates are not going down to 2%, I don't think, personally. I think that, you know, if you look at the life, yeah, thank you, 6%,
But
you
I'm
know,
not the expert, obviously.
while 6% may not feel good, it's, you know, in the big picture of life, it's not a bad rate. And so what that means is valuations have to adjust. And once valuations adjust, the market will kick in and it will get to work. And that trillion or so, what, 1 trillion, 2 trillion of equity sitting on the capital sitting on the sidelines will get deployed. And then we'll have a robust market. I think we're also going to be more creative about how we use office and how we lease office. And, you know, there's smaller space for people, but more space for gatherings. Is, you know, that's the big driver right now, is gatherings and community and collaboration in the office. It's something that I think that we'll continue to see, and I think that will evolve. I mean, just like multifamily evolved to enhance amenities, enhance community space, provide work from home locations, I think we'll see that in the office space as well. We're seeing it more and more. And then, you know, there are a lot of offices that are honestly obsolete, and we'll need to find a new place for those, or a new use for those. We have a lot of people to house, maybe that turns into housing. There's just a lot of things going on in our economy that I think we will use this time and these assets to repurpose and address. And I think that we'll see that toward the end of the year, whenever we can have big changes in the market. I feel like there should be big changes in the market, but we can't really have them right now, or won't really have them right now. And I think that we'll see those toward the end of the year or the beginning of 2025.
Well, I think it would be fantastic to have you both back again, actually, to have to see how right you were with your crystal balls at some point in the future.
Right, we're coming back.
Yeah, no, I think it'd be really interesting to see how it changes, because I think it is a fast moving market, and I think it would be really interesting to do a revisit of this if you'd be up for it. But it's been fantastic talking to you today. If people need to get hold or want to get hold of you to discuss any of the issues, or if they've got a problem they just want to chat through with you, where could they get hold of you? Do you want to start, Michael?
Sure. Well, it's you can reach me at Michael Friedman at Chapman Cutler on our website, or on my email, friedman@chapman.com. I'm always happy to chat with folks about distressed real estate or any other distressed restructuring issues.
Brilliant. What about you, Deborah?
Yeah, so you can reach me at CohnReznick through Debra.Morgan@CohnReznick.com. I'm also, you can find me on our website. You can find me on LinkedIn, Debra Morgan, and look for the Debra Morgan in Dallas. And I am here and would love to talk to you about commercial real estate and commercial real estate debt.
That's brilliant. Well, it's been great talking to you today, and have a great day.
Thanks, Rebecca. You have a great day.
Thanks for having us.